Pleasure now to bring on board Jonathan Garner to talk about Morgan Stanley's latest equity strategy report, the thinking behind it. Why do they like India? What about relative valuations? And on an absolute basis, where Indian stock markets and the economy is headed. Jonathan, good morning. Thank you for joining us. If I refer to your latest emerging market strategy note, you've moved overweight on India. You've downgraded Australia to underweight and Taiwan and China to equal weight. That's EW. So what's the thought behind increasing India's weightage from 6 to 1 at a time when your note specifies that valuations are less attractive than what they are right now versus what they were in the month of October?
So India rises to number 1 out of 27 markets that we cover in Asia, ex-Japan and emerging markets. We also like Japan, but that's a separate developed market decision. I think valuations have cheapened up for India since last October in relative terms quite considerably, as other markets in North Asia like Taiwan and Korea have outperformed the Indian market quite substantially. So there's better relative valuations than there were. But if we zoom out, really the medium-term story is what excites us so much about India. We're starting to see a trend of superior US dollar earnings per share growth over the cycle versus other emerging markets, and particularly versus China. And we're also seeing the currency, the Indian rupee, sustaining a real exchange rate trend that is stable to positive at a time that the Chinese renminbi, for example, has become really quite weak. So what we're seeing is portfolio investment is actually moving towards India at the moment. And that means that though the multiple in absolute terms, to answer your original question, about 20 times 1 year forward PE, may look high compared to emerging markets on about 12 times, this superior compound earnings per share growth and portfolio equity inflows likely keeps the market very well supported.
So is India, Jonathan, in your book, a buy both in absolute and relative terms? Because what we've referred to right now is not absolute comparison. It's more like a relative comparison.
Yeah, so our colleague Ridham Desai and the team in India, they have a target for Sensex of 68,500 and an upside bull case target of 80,000. And so that's the absolute returns upside that they see. For many of our clients who have a mandate to invest across emerging markets, they care more about that relative disparity, I guess, that I discussed in the answer to the earlier question.
Jonathan, if one looks at the global scenario, 2022, we saw mass outflows out of India to China. When we started the year, that pattern was at play. But since April, foreign institutional investors have come back into India, both by the portfolio route and by the FDI route. Do you think this could be a multi-year trend in making, and now we should get accustomed to strong flows by institutional investors, especially foreign institutional investors, into Indian equities?
Yes, we do. What we now know is that the economic recovery in China has been very lackluster. And certainly there is a debate amongst investors as to whether it's reached an important multi-decade transition. Its demography is quite adverse, and that's in contrast with India in terms of the population age distribution. And that matters not just for themes like consumer, industrials, financial stocks, earnings, but it matters for the demographic that can now buy equities in India. So again, for China, the near-term issue around leverage and the property sector's issues is causing a real challenge for policymakers, and it is weakening the currency. Whereas on my recent trip to India in June, I was very struck just how strong the economy is across the board in manufacturing and services PMIs, and real estate transaction volumes and activity, in inward FDI and infrastructure construction. It's a very interesting story to us in India.
Jonathan, specifically to one factor which you alluded to in your report is that we believe that we are in a profit cycle and it is only halfway through, with profit share in GDP from a low of 2% to going up to 4% and eventually to 8% in 4 to 5 years. If that had to happen, where profit as a percentage of GDP will go from 2 to 4 and 4 to 8, what will do well and what will not do well?
Well, that's work that's been done by our colleague Ridham and his team. We certainly concur with that. I think the engine of growth is going to be on the consumer and industrial side in particular. Though India has some very powerful export earning companies, that's not where I think you're going to see the biggest compounding in earnings per share growth on a go forward basis, particularly bearing in mind this point about local currency earning streams being more supported by a structurally stronger rupee. And so that's exciting. It means that India's earnings per share growth is now compounding much faster than peer group emerging markets in US dollar terms.
Jonathan, your report explicitly talks about where China was in the past, India will be in the future. Now, that's a very powerful comment, and I love when somebody says such good things about India, being an Indian. But can you elaborate more on that?
Well, if we simply look at metrics like GDP per capita, for India, we're standing at around 2,500 US dollars. China's about 13,000 US dollars. China's growth model is running into trouble. India's has a long way to run. If you look at leverage, household leverage overall in the economy in terms of debt ratios to GDP, they're still extremely low, a feature that is shared with Indonesia, for example, but it's in stark contrast to the situation in China or North Asia more generally. And again, we know that in this multipolar world dynamic that is ongoing, India has significant optionality there in terms of the way that firms from the United States, Japan, Taiwan, elsewhere are relocating at scale their production platforms into India. So there is an awful lot of room to run here in India's growth model. We're very excited about it.
If China continues on this glide path of earning contraction and economic contraction, what do you think it means for the rest of the world? I mean, both in terms of commodity pricing, the manufacturing, and the supply chains.
Well, in terms of the world generally, what you're seeing is nearshoring and onshoring and manufacturing FDI relocating to geographies that are, less challenged by, let's say, hegemonic rivalry between the US and China. So India is a beneficiary from that, but so is Mexico, and so are countries like Vietnam and to a lesser extent Indonesia. So this is a very important structural theme, and it's very different from the emerging markets theme, the more convergent world that we lived in, let's say, 2 decades ago.
Jonathan, so do you think that in this transition, as money migrates from India to China, we could be looking at serious changes in terms of capital allocation? We could be seeing serious changes in terms of MSCI allocation, because if I look at the MSCI emerging market allocation, China still has the largest weightage and largest component.
Yes, I think you may have misspoke there in your question. We're actually seeing that fund money is moving from China towards India, not away from India towards China. And we think that move towards India has considerably further to go. What we're starting to see is the development of the emerging markets ex-China product. India is a very large weighting within that index. And so when we look at portfolio flows generally, we are seeing that structural change that's underway. It's also ongoing into markets in ASEAN, like Indonesia and Singapore as well. But India is set to benefit significantly.
What could be risks to your thesis?
I didn't quite catch that, but I think it was, what is the risks to our thesis? Is
Yes,
that correct?
please. What could be the risks to the scenario?
Well, I think traditionally economic cycles in India have been interrupted by, in particular, rapid increases in the oil price, but we are not anticipating that on a go-forward basis, and the external position is much stronger than it used to be in terms of the reserve coverage of imports, for example. The current account deficit overall is at a very low level for India. I think the other longer-term issue which many countries face is climate change, the impact of climate change on the agriculture sector. And that's an issue that a number of emerging markets have to deal with.
Jonathan, we've got election cycle in India next year, then we've got a US election cycle. Two of the largest democracies in the world, they would be voting. Could that be a potential event of volatility, but not risk?
Well, we don't comment on election cycles in any geography, but what I would say, what matters is policy continuity and policy mix. And the policy mix recently has been very favorable from an equity investor perspective. That's why you're attracting far higher portfolio flows into equities and bonds than we've seen before. as well as foreign direct investment inflows. So that's the way that we would look at that particular question.
Jonathan, since you are making a case that what's happened to China in the past will happen to India in coming decade and coming years. Now, what happened to China was the following: big expansion in the real estate market, big expansion in per capita income, strong demand for commodity, and a huge jump in terms of consumer spending. Do you see all the so-called X or China factors playing out in India, both in terms of per capita, commodity demand, and also urban consumption demand?
Yeah, there's not going to be an exact mapping, but I touched earlier on the road to run in relation to GDP per capita growth. Overall economic growth can probably quite easily compound at 7% plus per annum. And I mentioned the leveraging up of the household sector's balance sheets as interest rates are much more, let's say, within a range, if not down, from levels that we've seen historically. So yes, certain of those trends can continue for a long way to go for India.
You've explicitly mentioned on the strong capex cycle in India. Where are you confident of capex in India? Government capex, private sector capex, where are you more confident of?
Well, both, frankly. The private sector has been quite important in delivering even on key large ticket elements of infrastructure. But it's that structural improvement in infrastructure across power supply, roads, ports, including the rapidity in which you can do container turnaround in ports. All of this is very important for inward manufacturing investment to really get going.
Domestic versus global facing sectors in India. I would like to bracket financials and capex in domestic, followed with consumption, metals, IT, and to some extent pharma as outward looking sectors. Do you see that the growth will be dominated by inward and domestic dominated sectors?
Well, the pharma sector has been somewhat challenged in recent years. I'm not an expert on it, but certainly the IT outsourcing sector is an interesting one because we now have the AI thematic ongoing. So we want to monitor that very closely for what it means for future earning streams there. But the core of our interest in India is about the domestic demand story and the development of domestic consumer markets, industrialization, urbanization, real estate construction, financial services, the development of that. If you look at, say, things like life insurance markets or mortgage, these are still very, very low relative to the sort of levels of GDP that we have in some of the more advanced parts of Asia economically.
Jonathan, what role do you think this kind of an high inflationary scenario will have on a market like India? Because in India, inflation has been notoriously high, especially in case of food grains, vegetable prices. I'm sure you've read about what's happening to tomato prices here. What role do you think inflation and rate dynamics will play in a country like India?
Well, I touched on that earlier in the answer to the question about risks when I mentioned climate change. And obviously from that, food security is an issue potentially, but not just for India. It's an issue globally. And obviously the conflict in Ukraine has had an effect there on food prices and likely continues to do so. So I group that as one of the risks to the scenario, but I don't think it's an overwhelming risk, and it's not likely to prompt the RBI into anything like the almost emergency tightening of monetary policy that we are seeing in some of the advanced economies.
Jonathan, if you have to, let's say, share a moot point with us, if you have to share a moot point based on the client engagements you've had and the number of clients you associate and the number of clients you deal with, how many of your clients right now have ignored India and now they are feeling what is called as the new millennial term? They're feeling FOMO.
I mean, that's you'd have to break it down into two buckets. If you look at global managers who can invest anywhere in the world in equities, they still hold very low weightings in India. They used to hold quite considerable weightings in China, but they've come down to approximately the same level as India now has. And those weightings are much lower than they hold, for example, in leading semiconductor stocks in Korea and Taiwan. So that group of global investors, they have yet to engage with the market in India. That's true. If you look at emerging market specialists, it's very different. They hold quite large weightings in India, and they're very engaged on the stock and sector side. And so that's a very different situation.
Jonathan, when a market goes through what could be called as a multi-year, and decadal strong earnings growth, do you think one should not compare the current valuations with the historical valuations? Because more often than not, I've seen fund managers and brokerages, they've always argued historical benchmark to judge the future.
You have to be careful about that, particularly when you're getting up this breakout in relative earnings per share growth. If you were to look at that India valuation of around 20 times 1 year forward PE for MSCI India, that is a rich valuation to history. It's about.
All right, that's the view coming in from Jonathan Garner talking about India, how India stands out as the number one among the 27 markets in the portfolio, how they're looking at a bull case target of 80,000 on the Sensex, and saying that policy continuity and mix is going to be key to watch down the line.